Morning. Good morning. Good morning, and thank everybody for coming out this morning. It's good to be doing these meetings in person rather than virtually, where we can share each other's time and ask questions personally. Before we get started, I want to make a few introductions. Here with Ihry today we have Shane Lark, owner-agent, Mike Cassette, agent on the board of directors, Dustin Ihry from the West Fargo office, Teresa Miller, Bethany Rentz, J.R. Ryberg, Russ Barker, Kim Story, and new to the team is Brady Weisenberger. I don't know, Brady, if you want to just say a couple words about your new position with us.
Like about 20 minutes?
Maybe 20 seconds. How was that?
Yeah, for sure. Thank you so much. Glad to be here. And, I'm new to the team as the director of benefits. Just want to tell you guys, from health insurance in the market's changing so much, and really with Ihry Insurance now has some opportunities, some specialists. To take a look at that. We know it's a struggle. We know no one likes talking about benefits and Medicare and health insurance. We do. Talk to your agent if you have questions, and let's sit down with you guys and just talk about what we can help you out with. But just want you to know that we have specialists here to help you out. In 20 seconds?
We're there.
Good call. Thanks.
All right. Thanks, Brady. Just a couple other things. RMA every year seems to have a hot button issue, and it looks like for 2022, it's going to be signatures. So we are going to be updating our power of attorneys with you guys. The FSA form, a power of attorney, seems to be the gold standard accepted by all the companies we work with. So we're going to ask you to get a copy of an updated POA from your FSA office. So you'll be contacted probably sometime this spring. Second of all the slides that we're going to be going through today will be available to you. Just let me know or let your agent know, and we'll email you a copy. And we are also recording this meeting, so you better behave yourselves. And it'll be available also, a link on your live event or through YouTube, and we'll also link it to our website. So it'll be available to you to watch 24/7 probably sometime next week. With that, we have today with us Rich Morrison, Vice President of Farm Services, NAU Country. He's going to lead us off. We're going to then go to Courtney Apperson, who is the County Executive Director for Cass County and interim for Trail County. And then we're going to finish off with Mike Gower, Lead Field Marketing Specialist with NAU Country. Rich, you're on.
All right, well, thanks everybody for coming out. I do have the quotes on the screen up here. These are live, and you can see that's a good day. So you're all making money just sitting here in the room doing nothing today, so that's good. Let me shut that down real quick, and we'll go ahead and get started. I really appreciate the opportunity to be with you live. I know the last couple of years have been adventurous for many of us. I know last year I recorded a webinar, I think, from the Hope office during the day, so it's great to be back in front of the live group and see so many familiar faces, and it's a great year. We've got prices at levels we haven't seen in a long, long time, so I think our opportunities here for this year are going to be very, very good. It's just a matter of being able to take advantage of them, and we're going to talk about some of that here this morning. Now, what's going on right now? There's a lot of things happening in the market. You can see we had, double-digit gains here this morning in the bean market, so there's a lot of stuff happening. Inflation probably still at the top of the list. Commodities are the darling investment class at the moment. We're seeing, especially since the beginning of 2022, I think that the federal government has finally come to the realization that inflation is real. It's not going away, and it's starting to scare some investors. You're seeing a lot of selling in the stock market. The Dow's been down almost 10 percentage points here to start the year. Where's that money going? A lot of it's shifting into the commodity sector, and so we're benefiting from some of that. Mr. Putin is having an impact on the markets lately, especially the wheat market. We're not sure what's going to happen over on that side of the globe, but the uncertainty is giving us a lift in wheat. South America got off to a fantastic start in their crop year this year. Then they kind of hit a bump in the road, especially southern Brazil, Argentina, seeing some extremely dry weather, and we'll hit on that here in a minute. We have not had enough of China so far this marketing year. China a year ago were huge buyers in soybeans, corn as well, for the first time in a long time. This year's been a little bit less. Now, as I say that, this morning, China did show up back in the bean market. They bought about 500,000 tons of beans this morning, so good news, and that's helping lift soybeans. Energy prices running at 8-year highs right now. Fertilizer prices continue strong. I think at the farm level, that's been the major story throughout the winter and heading into spring is availability of fertilizer. What's the price going to be? Certainly that'll continue to be debated here for the next few months. But really kind of underlying everything, we've got a good fundamental story right now in the grains. Ending stocks at the world level will be down this year on corn, beans, and wheat. So despite all the other stuff that's going on, all the other smoke, there still is a good underlying positive story here for the grains. But going back to what we were talking about a minute ago with commodities, the green line on here is the Goldman Sachs Commodity Index performance last year. And you can see commodities outperformed the S&P, outperformed world stock indexes. So commodities, had a fantastic year, and that's typical of an inflationary type of period. And it's also part of the reason that investors are taking some money and shifting it into the commodity sector. Now, commodities aren't just ag. This index does include energies, precious metals, the soft commodities like cotton, lumber, things of that nature. So it's a basket of commodities, but that sector certainly is performing very well. One of the biggest ones in the commodity index is crude oil. Crude oil tends to be the leader in the commodity markets, and if we all had it to do over again, we'd have probably filled this garage with crude oil barrels back in the spring of 2020. Mike you'd made some money filling them up at $10 a barrel. We've seen a definite rally with the reopening of the economy in the summer of 2020. The market continued to spike higher on into through the election. Of course, the first move of the administration was to shut off the Keystone Pipeline. That was a positive for the oil market. And then you got into November this past year, and the market dropped pretty hard. Anybody remember why? That was the Omicron variant. When the Omicron situation kind of happened right around Thanksgiving, I think traders were really nervous that the government was going to step back in and shut things down. That did not happen. Crude oil has resumed its rally, made a new high again yesterday, up at $88.54 a barrel. So I don't know where we're going, but we are trading at the highest level since 2014. And that's ultimately positive for the other commodity markets, at least for right now. The other big story I mentioned earlier was input costs. Now this is from Purdue University, and they were looking at rotational corn costs in Indiana, but I think it's pretty much the same everywhere. Fertilizer costs up about $125 an acre this year, give or take on your farm, but that's the story right now that we're all looking at, and everybody's trying to figure out what the impact is going to be on planted acres this year. We've had numerous analyst estimates coming out over the last few weeks, and the range is as wide as it's ever been between the high and the low, which tells us that we really don't have a clue what farmers are going to do this spring. I think the majority of producers are going to probably plant the same rotation they've been in. But I think we also still have more acres this year that maybe changed hands or whatever the case is that could shift back and forth. So that's going to be something we definitely watch here in the next couple of months. Before I get into the crops, this is a snapshot of the hedge fund position in combined corn, soybeans, and wheat. And it's pretty interesting to see as we start the year. I told Shane I was going to do this, or Kurt, that I was going to do this a few times. This doesn't show up on the screen, but you can see the red line up at the top. The funds are long about 600,000 contracts of corn, beans, and wheat here at the beginning of the year. Today we'll get an updated report later this afternoon, likely show that they've added to that length this last week with the rally we've had. And you can see the black line is where they were back in 2021 with their total position. So they've been optimistic, they've been willing to hold the grains, and I think that that makes some sense given the demand, given that stocks are down, and given everything else that's going on in the economy, that this is a good place to put money. But you can see the black line shows what they did last year. They were long a record at this time, about 800,000 contracts. And as you went into the summer and into the fall, they sold off quite a bit of that. And part of the reason was we had really good U.S. crops in most areas of the country, maybe not here locally, but generally we had some good crops. And we had big acres getting planted in South America. All of that thrown together, funds liquidated some of their length. But you can see they've been adding back again this fall and on into the winter period. A lot of that's weather in South America, uncertainty with wheat, whatever the case is, and of course, concerns about acres this spring. So where do they go from here? I guess I think good and bad. I think the positive here is that these funds recognize that there's not a lot of risk maybe at the moment in being long corn, beans, and wheat. And I think that that's probably true, at least for the next 2 to 3 months as we go into spring. The risk that we have, though, is if these people decided tomorrow that it's time to get out for whatever reason, you know, they're long 600,000 contracts that they could turn and dump on the market at any time. So I don't think that's likely to happen yet, but I think that's something to at least be aware of as we go into spring. So I want to start out with the soybean market. Soybeans have probably been the most volatile, certainly, of the grains here this winter. And 2 weeks ago, we got USDA's final 2021 production numbers out. Came out with the final U.S. number, final state numbers. You can see here the red states went down from last year. Blue states all went up. Of course, we did have the reduced crop in the Dakotas and Minnesota this year. The North Dakota state yield at 25.5 bushel an acre. The blue states all went up, and it was really interesting. Every state east of the Mississippi River had a record bean yield this year. In addition, so did Iowa and Nebraska. So the U.S. bean yield was at 51.4 bushel an acre. That was up about 1% from the previous year. And when you dump that into the balance sheet, USDA did raise production in the report 2 weeks ago about 10 million bushels, and they raised ending stocks about 10 million to 350. Now, you may not remember this, but a year ago at this time, USDA was forecasting last year's ending stocks at 140 million bushels. And it was all the way till the end of the summer in September that the government went back and found 100 million extra bushels in last year's crop in that September stocks report. Added to this bottom line number here, which flows into this year's balance sheet, puts us at a pretty comfortable situation really on beans at 350 million bushels. The one number I'm really concerned about, though, is this export number. So far this year, we're running behind pace needed to reach that 2.05 billion bushels. And a lot of analysts are thinking that that number's too high, that it may come down 150 million bushels at some point. If that happens, that would just feed to this bottom line number here. So the U.S. balance sheet situation is really very comfortable right now, probably doesn't warrant trading to $14 beans right now. And here's the snapshot of our export numbers. And there's two issues that we've got this year. Number one, at the start of the marketing year in September, we had Hurricane Ida hit the Gulf of Mexico. And it shut down the Louisiana ports for about 3 weeks. So at the beginning of the marketing year, we didn't ship any beans out of the Gulf. The only beans that left the country were off the Pacific coast. We finally caught up or started catching up in October. You can see the weekly shipments started to pick up. But look what's happened over the last few weeks. We've really tailed off on bean shipments. And to me, that's a little bit disturbing. Again, go back to that number in the balance sheet. Can we hit 2 billion bushels? I don't know if we can, given the pace that we're on. The other side of this is, as you get into February, March, we really start to crank up South American loadings. And you can see why is that Brazilian beans, Argentine beans, priced well below U.S. beans in the world market right now. Now, China cannot buy all of their beans out of Brazil. They have to supplement with U.S. beans. They just don't have enough loading capacity in Brazil to be able to handle everything that China is going to need. So they will continue to buy U.S. beans. even at a little bit higher price. But you can see why they wouldn't want to pay 14 something a bushel for U.S. beans when they could buy South American beans for 35 bucks a ton cheaper. And it's showing up on the export numbers. January exports out of Brazil this year expected to be close to a record high. And part of that is because they planted the crop quicker this year. The Mato Grosso beans got planted at a record pace this spring. They had a great growing season in the northern parts of Brazil. They've already harvested 13% of the crop in Mato Grosso, and some of the beans are already at the port. And February is expected to possibly be a record because of that early harvest. So that's a negative for the U.S. Now, looking at the whole country as a whole in Brazil, this is from 2 weeks ago, but CONAB is a Brazilian government agency. They estimated the crop in Brazil at 140.5 million tons. That would be above last year's record at 137. This week we've had 3 analysts come out with their numbers for Brazil. One was at 132, one was at 133. This morning, one was at 135. So they've reduced that number because of drought in the southern part of the country. And as you look at the soil moisture availability as of January 10th, this area through southern Brazil and into Argentina has been extremely dry. And that's the area of concern. And that's a typical La Nina weather pattern, where we tend to see that southern half of the continent be dry, the northern half tends to be wet, and that's what they've seen this year. Now, right now, this is the 16-day forecast for southern Brazil, Argentina. Shows most of this area getting some pretty good rains. However, I think the traders have been burnt on this long-term forecast before. Most of them are looking at the shorter-term maps. And yesterday's 4-day forecast shows that area in green right there. That's the key dry area right now. And they're not expected to get much rain in that part of those countries for the next 4 days or so. And so we'll be watching real close the noon weather forecast today. It's just like middle of July here in the U.S. down there. You know, they're really paying attention to the weather forecast, and that'll dictate how we trade going into the weekend. But this morning, it looks like everybody's expecting a dry forecast heading into the weekend. So it is a weather market, and you know how weather markets are. They can be pretty fickle at times. Look at the funds position just in beans only. Last summer, August, they were long about 100,000 contracts, the black line. You can see that they sold quite a bit of that off into the fall, whittled that down to basically almost nothing. But they've been on a big buying run since the middle of December. And that's the return of the weather market here in soybeans. And if you, so historically, they still have room to buy. You know, they're well below last year's record high length in the bean market. So as you look at this, you'd say, you know, they're not topped out yet. They still probably have money that they could continue to invest if they wish to. Now, you compare this sell-off that we had through the summer into fall to the futures chart. You know, you can see that they were predominantly the reason why the market sold down. We went down to $12 in the fall, made it low, but then we started getting into some weather issues in the southern hemisphere, started really seeing some buying take place in the middle of December, and it shot us all the way up to a new high here this morning at 1466. So where does it go from here? I don't know, but the relative strength index at 70, almost 71, stochastics lines would indicate this market's probably starting to get at least short term a little bit toppy. If you had any beans left, I would have sold mine out probably at 13 bucks. I'll just tell you that up front. You know, do you want to play a weather market? But my strategy this year has always been to make sales and buy calls. I would rather own it on a piece of paper with a call option. I'm not afraid to spend 15 to 20 cents on a call in beans. Market can get you that in one day or lose you that in one day pretty easy. So I still think that's a good way to attack this market. If I had old beans left, I'd probably cash them in, maybe go buy a $15 or a $16 make call and ride that. And if the market goes higher, great. If it doesn't, I've cashed in, I got my money, and I'll go down the road. The corn market. Corn's kind of been the follower of wheat, been the follower of beans, but it doesn't seem to want to give up. These are the final yield numbers for 2021. Again, the red states went down, the blue states went up from the previous year. North Dakota state corn yield was at 105 bushel an acre, down about 25% from the previous year. Overall, U.S. yield was a record at 177 this year. And when you plug that in the balance sheet this month, along with a little bit of a bump in harvested acres, the crop went to 15.115 billion bushels, almost a record, just shy, I think, of the 2016 crop year. Ethanol production went up, export demand went down in the report. USDA raised ending stocks about 50 million bushels. Now, 1.54 billion is not a huge number historically in corn, especially with the rise in input costs this year. And I think that a lot of traders have been looking at this saying, we've got to incent producers to make sure we don't plant a whole lot less than 93.4 million acres this year. And I think that's the task of the corn market right now, is to make sure acres don't fall dramatically. We'll look at acres here in just a minute. Export numbers have started to climb on corn. This is pretty typical. As soybean loadings slow down into spring, corn loadings really start to go up the second half of the marketing year. So that's a positive, I think, as we go forward. However, funds, they're kind of longed out right now. They're holding about a record long position in the corn market. Question is, will they decide to make it a bigger record? You know, where are they going to go from here? And so I don't think that they're going to sell out anytime real soon. I'm fairly well convinced that this corn market's going to hang in here at least for the next 3 to 4 months until we make sure that we get these acres planted this spring. So I think the funds are pretty satisfied in holding length in the corn market. It's been working for them. I don't think we're looking at a sell-off. So here's March futures. It's, you know, over long haul, it's been a range-bound $5 to $6 market. But you can see we've been increasing the bottom end of that range as we've climbed higher. We are looking at an RSI this morning at about 67. Stochastics lines might be getting a little bit toppy as well. So heading into the weekend, you know, who knows if something changes over the weekend, maybe we'd trade down on Monday. I still think if I've got old corn, same strategy, cash it in, go buy an out of the money call, and in case the market goes higher, if it doesn't, I've got a minimum locked in. I could probably have minimum futures above $6 and still have some upside potential in the market. The wheat market, now going back 2 weeks ago when we had USDA's crop report out, the wheat report was bearish that day. And so we did see wheat sag a little bit after that report. USDA did lower the feed usage number this year. They lowered exports. They raised ending stocks. Now, this is a 9-year low in wheat stocks. So that's been supportive over the last 6-8 months. But the fact that that report number went up, it was negative when the report came out. And similar at the world level, world ending stocks are going to fall for the second straight year. But when the report came out 2 weeks ago, it was bearish because USDA raised that stocks number. Now, a lot of that's changed in the last 10 days. We're watching what Mr. Putin's doing over on the other side of the globe, right? And we're watching our government's response to what he's doing. That's maybe more important. It seems like when President Biden talks lately, the wheat market goes up. So I don't know what you want to have happen, but and there's a reason for that. Russia accounts for about 24% of world wheat exports, and Ukraine accounts for another 9%. So if they were to get into a conflict and, let's say, start lobbing bombs at each other, you got 33% of the world wheat export market that's tied up over there. And so that's why the wheat market has responded favorably to anything that would be a threat. We've seen some premium built back into this U.S. market. You know, the United States, France, Canada, Australia would certainly be beneficiaries if those two countries can't export wheat, at least for some period of time. One of the big reasons or big movers, of course, the biggest mover in wheat's been the spring wheat market. Now, this is a snapshot of Paris milling wheat, French milling wheat futures. And it's really been the driver. And you can see what's happened. You go back to last summer, late in the summer, we've had a heck of a rally in milling wheat futures around the globe. Many end users have struggled to find supplies. And so you've seen a lot of bids, and we continue to see those bids rise throughout the fall and into the winter period as the end users scrambled to find high protein wheat. We had a drought, we had reduced stocks in the United States, Canada had reduced stocks this year. The Aussie crop was lower in protein than expected when they got into their harvest. So there's been a scramble at the world level to find wheat, good milling wheat supplies. We got to about Christmas time and the bids just dried up. Apparently everybody found their needs, got covered, and we started to see French milling wheat futures trade lower into the first of the year. Now take a look at that chart, and then here's Minneapolis March wheat. You can pretty well tell what Minneapolis wheat's going to do today by what French wheat did overnight. It seems to be, you know, it's just following right along for the ride. We traded up to new highs here in December, traded back down to a new low. Market was way oversold technically, You can see the RSI had been below 30 for a number of days, as well as the stochastics lines. We finally found some support at the 200-day moving average, and then the market rallied on the Ukrainian news. Here the last couple of days, we've backed off a little bit, and I think they're talking about this some Paris talks possibly coming up here, and maybe we'll get some sort of a resolution. So the rhetoric is going to mean a lot right now. It seems to be what's driving the wheat market. Now, I think going forward into spring, I think we're going to shift the focus away from spring wheat into the hard red winter wheat. We did get a winter wheat acreage report out 2 weeks ago. They did raise wheat acres 800,000 this year versus a year ago. But I think the big story in wheat is going to shift to the southern plains. And I think some of us were talking beforehand. In the grain business, there's an old saying that wheat has 9 lives. It seems like you kill wheat about 8 or 9 times every year, on paper at least. I think we've killed that crop at least twice so far this year with some freeze frost. And I think going forward, there's a potential another story here. If you look at December precipitation in the old Dust Bowl region, they've not had any. And I was visiting with some folks from Texas last week. They think they're going to have some wheat that's going to be 100% lost this year. They said wheat's blowing out of the ground. You may have seen some of the videos from out in Colorado and surrounding states in the last few weeks. But they're losing wheat coming out of the ground. And I asked, will you tear it up and plant something else? And they said, not unless we get some precipitation. If we don't get any rain, we're just going to let it sit and take the crop insurance payment and go down the road. Maybe if they get a little precipitation, you might throw some sorghum in the ground. But going forward, the month of February is still expected to be more of the same. That region's expected to be very, very dry. And this is the March, April, May forecast, shows more of the same, more dryness in that part of the world. So again, without precipitation, I don't know what they're going to do. I know western Kansas did get a little snow over the last few days, might save some of the wheat in that part of the world. But to me, this is a pending story that might start to take over the wheat market as we go into spring. Oh, by the way, I guess I should have pointed out here that the March, April, May forecast does show the northern belt expected to be a little bit above normal on precipitation, as well as the Ohio Valley. So we'll kind of watch that as we go into spring as well. So flipping ahead to 2022, I think this is the biggest story going into spring is the corn-bean spread or ratio. What happens with that 180 million acres a year, give or take, that goes to corn or soybeans? You know, are we going to plant 90 million of each? One going to be higher than the other? In my travels, I think most producers, I would say 90% of producers already know what they're going to plant this year. I know a lot of fertilizer goes on in the fall. Guys do rotation, same rotation every year. But there's that 10% of acres that maybe swing a little bit. Where I live in Western Illinois, I've seen more land sold this winter than I can remember in my 30-some years in the business. So we're seeing a lot of land change hands, a lot of cash rent moving around. And I think it's that ground that's potentially could swing back and forth depending upon fertilizer availability, how much work they've got done, all of that. So that's why we're watching this spread pretty closely. Now, if you go back to September, we had this ratio at 2.5 to 1. And all the news was we're going to plant wall-to-wall beans this year at that kind of a price relationship. Things changed as we went into the end of November. That ratio fell into about 2.2 to 1. We started getting some of the university folks saying, we think corn pencils out better than beans. And so University of Illinois, Purdue, they were putting out big corn numbers at that time. Now we've seen this ratio go the other direction with the rally in beans lately. Now we're about 2.4 to 1 again. So I don't know what's going to happen as we go into spring. I don't know how many acres there are that could possibly swing back and forth. But the trade seems to be in a debate on that right now. Last Friday, Farm Futures Magazine put their latest survey numbers out. They were guessing corn acres at 90.4 million this year. That's down 3 million from last year. And they were guessing bean acres at 92.4 million, up 5.2 million from a year ago. If that happened, it would be the second year ever that bean acres are above corn acres. So we'll see. They had winter wheat acres up 1.6, spring wheat down 612, total planted acres up about 3 million. So what are other people saying? Well, Informa commodities, or now they go by IHS Market, they were at 91.5 million corn this week, beans at 87.8. ADM came out at 93 million corn, 87 beans. I mentioned the farm futures numbers. University of Illinois back at the end of November, early December, they were at 96 million corn. That was when that ratio got into 2.2 to 1. So you can see we got a pretty wide swing here at potential acres this year. And so I did a couple of what ifs on the balance sheet and took the high and the low of the guesses so far. Farm doc on beans, they were at 85.5 million. That would be down 1.7. If that happens, well, let me go, the other side of this is Farm Futures Magazine was at 92.4. So you got a 7 million acre swing or difference right there. I can never remember a year, what are we, January, where we were talking about a potential 7 million acre swing in bean acres. But that's the difference between the high and the low. Now, if I plug in the same yield, same demand for next year, with Farm Doc's number, we could have ending stocks just slightly higher, but with Farm Futures, we could more than double bean stocks this year. So if you think there's a chance we're going to plant 92 million acres of beans, we need to be selling the heck out of this bean market if you think there's a chance of that happening. Now, ignore these lines on here for just a minute, but the bean market has been pretty flat all the way through fall until early winter, and now we've started to see this thing climb, and that's all been because of South American weather. Here today, we've traded up over $13.50 a bushel this morning, so I think it's a great opportunity to get some hedges on the books. I've been suggesting for the last month, a third of the crop, give or take. I wouldn't mind having sold. That still leaves me 2/3 unsold. I think that's a great position to be in. If this thing keeps climbing, keep looking to lock some in. And if you get a sag back in the market, maybe you look at buying calls then to help cover those sales. By the way, the RSI pushing right at 70 stochastics lines would indicate maybe this market's getting a little bit toppy. Looking at corn, again, big variance. Farm doc at 96 million was the high guess. Farm futures at 90.4 million was a low guess. So there's 5.5 million acre difference. And if I put the same yields and same demand in, I've got a billion bushel difference from my high to low ending stocks. Billion bushels is a big deal. You go from a sharply lower market here to probably a steady, if not slightly higher market on this side. And so again, this is why this acreage number is going to be important. And USDA doesn't put out its first official set of numbers till March 31st. That's when they put their first planting intentions report out. So we've got over 2 months to debate this thing and see what happens. So looking at corn, we've had a nice rally in this corn market. Again, it's trying to make sure it doesn't lose acres this year. And we've traded up over 570 this week. I think it's a heck of an opportunity to, again, get some priced. I'm thinking at least a third of the crop. If you got profit in this thing, I think that's what it boils down to, is locking in profit. I talked to two guys in southeast Missouri a couple of weeks ago. They were 70% hedged on corn at 550, so it's gone up since then. They were actually hoping the market would drop so they could buy calls against the sales they had made. But their point was, I've got a heck of a profit locked in. We had all of our fertilizer bought before the rally, so we've got great profit margin in this thing. We're going to sell it. We're going to buy crop insurance to protect the downside as well. We think we're going to have one of the best years we've ever had. And I can't disagree with doing that. Lastly, wheat. I think everybody's in agreement that we're going to see some increase in wheat acres this year. Back in October, or November, I guess it was, USDA did put out some preliminary numbers. They were at 49 million acres. Farm futures is at 47.6. Both of those with a good yield, you would see an increase in stocks this year. So if I'm planting wheat this spring, I'm probably looking to get some sold as well, especially up at the $9 mark. We've been above it a few different times. I think it's a good opportunity. Now, the RSI and the stochastics are both pretty neutral at the moment. Maybe today's not the day, but if you get Mr. Putin waving his sword again next week, we get a little bounce in this thing, might be a chance to get some wheat on the books as well. So crop insurance this year, what are we going to do with it? Well, I'm a market guy, so I like to look at the price side of revenue. The formula for revenue is yield times price. I can't guess what's going to happen with yield this year yet, but I do know where prices are at today. Next Tuesday, we start setting our crop insurance base prices. It's a heck of a time for a rally. We're getting the opportunity to lock in some really, really good numbers for this year. And starting out with spring wheat, if we're at this morning's numbers, I just updated this morning. Right now, we were at $8.80 on the September contract. This would be the highest spring wheat base price we've had since 2011. And look at the previous 5 or 6 or 7 years that we've been through. You know, yeehaw, this was pretty exciting, wasn't it? $5, $6 wheat. Now you're at $8, almost $9. I think we've got a heck of an opportunity with revenue insurance this year. Same with soybeans. This morning we were $13.51. If that were to hold through February, it would be the highest we've ever had on beans for a base price on insurance. So pretty interesting to me that, again, we can lock in some good revenue guarantees this year. And for corn at $5.68, you know, we're amongst the highest years we've ever been as well. So I'm looking at this as a tremendous opportunity this year. Who knows, next year, the year after, we may be back in this range again. So I definitely want to take advantage of the opportunity we've got here in 2022. So two of the products that we've got that are RMA products are SCO and ECO. And I know a lot of crop insurance companies, including ourselves, we've got some private products. Those are not subsidized by the government. These are. SCO is supplemental coverage option. SCO is a county level protection that starts at your level of coverage on your individual policy and goes up to 86%. ECO was new last year, and it allows you to go further, start at 86 and go to 90 or 95%. So the idea this year is how much of your deductible do you want to cover, how much protection do you want, how much price protection do you want to build in. That's kind of the way I'm looking at it. And here's kind of a graphic showing you how these policies work. If I buy an individual coverage, let's say 75 or 80%, that would be this blue part of this chart. Next would be SCO. SCO starts at your level of individual protection, goes up to 86%. It does say on here you can only do SCO or ARC. I'll talk about government programs here in a few minutes, but you can only do one or the other. You can't do both. There's some major differences between SCO and ARC that we'll hit on in a minute. Next, you can go to ECO, 86 to 90 or 86 to 95%. So to me, it comes down to what's my goal with crop insurance this year? Is it just to cover my basic expenses, or is it to try to lock in a profit? And this is the first time we've been able to do this in a long, long time. So go back to the price charts that I showed a minute ago and look at the lines on here. If we were to start at 570 on the corn price, the green line towards the top. Now, I don't know where we're going to shake out for the month of February, but if we start at 570, and let's assume this year we have an average crop. Let's assume my farm's average, the county's average. If I buy an 80% RP policy, then my price protection essentially with an average yield would start at 456. To have a revenue loss, I'd have to have a 20% drop in price. If I add SCO this year, again, if the county has an average yield, now my price trigger goes up to 490. If I add the ECO up to 90%, now my price trigger jumps to 513. That's what I'm looking at this year. Can I cover my costs? Can I lock in a profit margin? I know people are talking $4.50, $4.75, $5, depending on who you are as your cost of production. I can utilize these policies hopefully to lock in a profit margin this year. Not just hope to cover some of my costs, actually lock in a profit. So we've got a few different tools that we have available to be able to walk you through the policies. This one here, this Indemnity Worksheet, really takes you through the math of the policy. I'm a numbers guy, I like to see the math. And what I'm going to show here is assuming an average yield in the county. I ran this for Trail County, and the Trail County's expected yield on corn this year is 161.3 in the yellow box on the left, and I'm going to assume that that ends up being the final yield as well. So yield is unchanged. Next, straight up the middle is my protection this year, and what I ran here was assuming I buy a 75% RP policy on my farm, then I'm going to add county level protection from 75 to 90. The first part of that was with SCO from 75 to 86, and then ECO up to 90%. You can go to 95 if you want, but I just ran this to 90. So I've got 15% band of county level coverage. Next, we look at our coverage. How many dollars of protection do we get? And with ECO and SCO, we get to use our APH. In this case, I plugged in 175. Your APH, the higher it is, the more dollars of protection you get. So in this case, I used 175, and you multiply that by the higher of the base price or the harvest price. With a revenue policy, you get both. So in this case, I said we started at 570 corn, and in the fall next year, we drop $1 to 470, which is still a high price historically, but it's a $1 drop. So we take the highest one of those two times 175. My expected crop value then is $998. almost $1,000 an acre this year. Multiply that by my percentage of coverage, 15%, we get our dollars of protection. So that 15% band of coverage is worth just under $150 an acre, that green box on the right-hand side. Then we get to the fall, we calculate our county loss. We started out with $919 of expected county revenue. The end of the year, we ended up at $758, so we ended up producing 82.5% of our expected county revenue, which is below our 90% trigger. That means we're going to have a payment. We ended up with a 7.5% loss. We divide that into our band of 15%, so we're going to collect 50% of that band because of the drop in the price, which means we're going to get a check for about $75 an acre. And that's only because of the price drop. We didn't have any change in the yield, so yield change will impact this as well, up or down. But just if you're looking from a price perspective only, then we're getting some protection here by bumping that coverage up. If I'm buying, say, 75% RP on my farm, or even 80% RP, and nothing else, and let's assume that we have an average yield on the farm, we would not have had a big enough drop in price to trigger any kind of a payment. So by going up to this next level, this is how we're protecting that. So it's shallow loss coverage, but if I'm concerned this year with where prices are starting, how high we are, that we could see some price drop, then maybe this is something you'd want to look at. What I showed you there was just one scenario, bushels and yield or price. This one's going to show you, this matrix shows you over 200 examples. So all the red and pink are actual payments. We got yields across the top, we got prices on the left-hand side. And a few things I would point out on here, just going around the matrix, if we had a good county yield, let's say we end up at 165 this year, price goes to $5, we're going to start to trigger a payment. At $4.99, we're getting $2.99. So basically, to me, that's pretty phenomenal to think at $5 corn, I could start getting money back potentially. What if we end up down here in the bottom left-hand part of this chart? You can see that we maximize our payment. We get that entire $149.63. That's because we've had a big enough loss. We've lost that whole 15% band. And actually, at this point, is if you had 75% RP coverage, that's when that policy is going to start to kick in then as well. What if we end up at the top left? You end up with a 123 county yield, corn goes to 770. My payment goes up to about $181. Now, why is that when I only had 149 in this, 149 in the green box? Well, that's because price went to 770. We get to put that number in the harvest box. We use that then to recalculate our dollars of crop value, which increases that green box. So that's the benefit of having the harvest revenue option or the harvest price option on your policy. When the market goes up in the fall, you get to recalculate your guarantee. I had a guy the other night ask me, what happens in these white boxes over here? What if we end up over here? My comment was, you probably had the best year you've ever had farming corn, because you're sitting here with 160-something bushel corn, average in the county, prices are $5, $6, $7 an acre. So you paid the premium, you didn't use the policy, but you've had a tremendous year. So that's the best case scenario on this whole thing, is you buy it, you didn't need it, and you have a good revenue from the crop. What I wanted to show here, these yellow lines on the right-hand side would represent if I'm only buying 80% RP coverage, and the left ones if I'm buying 75%. If I'm buying 80%, everything to the right of those yellow lines would be blank. Those would all be white. That's where my coverage would start. If I was 75%, it would start at those left lines. So everything to the right of those would be blank. So what's your goal with crop insurance this year? Is it just to cover part of your expenses? Is it to try to lock in a profit? Now, I think a lot of folks are looking at it this year as and this may be the year, that you do something different than you've done in the past, where you buy up a level to try to lock in some profit. Next year for $4.50 corn, we may back down again or something. But this year, I wanted to show you this to make you kind of think about what could be done this year. We've also got within our quoting software this historical tab. I can go back and look at the county, what would have happened had we had SCO and ECO. ECO was new last year, SCO is 5 or 6 years old, but we can go back all the way to 1992 if you want and see what would have happened given what the NASH yields were and given what prices did in those years. So if you're interested in different crops, different counties, we can show you that as well. One thing I guess I would point out here, this is Trail County corn, and 11, 13, 14, those were all years where we started with high prices and the market went down. So just kind of think about that. That's where we're at again this year. Price is the highest it's been since 2011. Same with soybeans. You look at soybeans on the futures chart here. You know, if I buy 80% RP coverage right now using a 13.20 base price, then with an average crop, my price protection would start at 10.56. 86% SCO bumps that to 11.35. 90% would get it close to $12. And in fact, if we were to start up at 13.50 where we're at today, that 90% would probably get you to 12 bucks or above. So pretty interesting to think about. Spring wheat, given the slope of this rally we've had since fall, you know, a lot of these triggers are well up into where the market's been trading. SCO would get you to 774 at 86% and ECO at 810 at 90%. So take a look at these this spring and see what you think. The last topic I want to hit on is government programs. We have an election to make here by March 15th. You probably have heard from your FSA office that we need to get that done. I put out this letter a few weeks ago telling you should talk to your crop insurance agent first before you go to the FSA office, and there's a reason for that. Let's go back to the old the Farm Bill. When it was passed in 2018, your initial election was a 3-year election. After that, each subsequent year, you get to re-elect a program between ARC and PLC. PLC is price loss coverage. If the market year average at the end of the year ends up below these blue numbers, you get paid the difference times your payment yield times 85% of your base acres. Keep in mind that these programs pay on 85% of base acres. Crop insurance covers 100% of your planted acres. That's a huge difference. So last year, the year that ended back on September 1st, this second column, these were the market year average prices. The ones in yellow were the ones that would have paid a payment that year. So anybody with a wheat base that had it in PLC last year should have collected 45 cents a bushel, times your payment yield, times 85% of your wheat base acres. You didn't have to plant wheat, you just had to have wheat base. The year we're in right now, we're about halfway through this marketing year. Here's where we're at so far. All prices are up. None of these crops, except for peanuts and rice, are expected to pay this year. And quite frankly, going into 22, I don't see any way that any of these crops are going to pay next year. I don't think we're going down to 370 corn, 840 beans, or 550 wheat. So I don't think PLC by itself is a good choice. So should I consider the ARC program? Well, ARC is going to use these red numbers for the 22 crop year. Not a lot better. Corn at 370, wheat at 550 are the same, beans are at 912. But for ARC, it's a revenue program. We take this number times your county's 5-year Olympic average yield times 86% to come up with the ARC trigger. So is that a good option? Well, given where prices are at today, you'd have to have a heck of a drop in bushels next year to start to trigger any kind of a payment there. Is there an alternative? The alternative is SCO. We've talked about that a minute ago. But supplemental coverage option is similar to ARC. The government won't let you do both because they're similar. They're both 86% triggers. Both are county-based products. Some differences, you got to buy SCO. ARC is free. ARC covers 85% of your base acres. SCO is 100%. The biggest difference this year is the price, where we're starting at. A year ago, we wouldn't have been talking as much about it. 2 years ago, we definitely wouldn't have been talking about doing much. But this year, with where prices are at, I think it's worth taking a look at. So I've got your decision right here, and you can probably guess which one is which. Option A is the ARC program. If you decide to sign up for ARC, we're going to start with a 370 price times the ARC county yield, which is 174.48, times 86%, would give you a $555 trigger for Trail County. The cost is zero. I can walk in this afternoon, say, put my corn in the ARC program. I've got a $555 trigger. One thing to note, the maximum dollars you could get from ARC would be 370 times the 174.48, times 10%. So $65 was the max in a total loss situation you could get from the ARC program. Option B is SCO. The reason we're looking at this so much this year is because of that price at $570. We're $2 higher than the base price. 2 years ago, what was our base price? Just over $4, $4.15. Wasn't that big of a difference. So maybe it wouldn't have been worth buying it. This year at $570, our Crop insurance county yield is 161.3 times 86% would give us a trigger of $791. So we're picking up an extra, $236 an acre in protection. It does cost you $13.56 an acre when I ran this yesterday for a band of 86 to 75%. So if I start with my 75 RP, add 11 points, it would cost you that. That band would be worth $101 compared to the 65 up here. If I had a total loss, then yes, ARC would pay, but this one's going to pay you more. So this, to me, is the decision you have to make relative to the Farm Bill this year. Do I buy SCO? If I decide, yes, I'm going to add this to my policy, then I cannot sign up for the ARC program. I would have to sign up for PLC. If you decide not to do this, then I'm probably going to put it in the ARC program. If we happen to have a county blowout on yield, ARC might pay. I don't see any way PLC is going to pay. So then I would probably put it in the ARC program. But to me, the number one decision you have to make before you go sign up is right here. Do I buy SCO? If I decide to buy SCO and I accidentally sign up for ARC, your SCO would be voided and you have to pay a 20% premium penalty. So don't do it. That's why you have to make this decision first and then go sign up for PLC if you decide to. Similar with soybeans, if you look at the ARC program, we're going to have 912, 4191 is the county yield at 86%, would give you a 329 trigger, cost is zero, the maximum you could collect from that would be $38. Or B is SCO. SCO right now, shoot, today we're at $13.50, but I plugged in $13.20 yesterday when I did this, times 41 bushels times $86 or percent would give me a trigger at $465. So I'm picking up, $130 some in protection for $6 an acre. And that band would be worth as much as $60. So again, this is a decision you need to make first before you make your final decision on FSA acres. Now I would imagine you could, if you've made a decision already at the FSA office, I'm sure they'd let you change it up until the 15th of March. But this is the most important. You don't want to overlap ARC and SCO. So next year, I said this earlier, last year, we talked about these programs. They weren't as exciting. Bean price was $11.87, I think, last year. Corn was $4.58. 2 years ago, I wouldn't have spent the premium because ARC was very similar to SCO. It wouldn't have made a lot of sense to do that. This year, it makes some sense to take a look at it. We'll wait and see what happens a year down the road. Just a few other points to remember here. Producers can purchase ECO. ECO is enhanced coverage option. That's the part that starts at 86, goes up to 90 or 95%. You can buy ECO no matter which program you sign up for. We had some guys last year around the country that decided the best bang for their insurance buck was to take the ARC program and then just buy ECO, maybe 86 to 95. Have that shallow loss band of coverage in case of a price drop. Still have my individual coverage, maybe at 80 or 75%. Leave a gap in your coverage. You can choose to do that if you wish. I'm not suggesting you have to or should, but you can do that. These crop insurance products protect 100% of your planted acres. ARC and PLC are on 85% of your base acres. That's significant. It also is important to take a look at each farm by itself. You may have a farm that you have a weird amount of base acres of one crop you don't even grow anymore, or vice versa. I know some of you may have heavy wheat bases. Maybe you plant all corn on it. So ARC versus SCO maybe doesn't even come into play on those. The insurance products do include the harvest price option as long as you have an underlying revenue policy. PLC is only price drop only. ARC does not contain the harvest price option. There might be places in North Dakota this past year that had bushel losses, but because the price went up, it offset the drop in the yield, and you may not get an ARC payment in some of these places, whereas SCO would have paid. So ARC does not include the harvest price option. So coming up Tuesday, we start setting our crop insurance prices through the month of February. It's a good time if we can hold this rally. The 9th of February is USDA's next report. 2 days later, I'll be hosting my NAU Country Aftermath webinar. We do this every month. Normally, it's the day after the crop report. February, it'll be 2 days after. But we basically cover the same stuff we did here today. So if you're interested in listening in, that starts at 9 a.m. That day. If you miss it, we do record it, and you can go to YouTube and type in NAU Country, and see all of the different webinars we've got on there, including the aftermath. The markets will be closed on President's Day. The 9th and 10th, we'll do it all again. 15th of March is the sales closing for crop insurance, and it's also the deadline at the FSA office. So I know none of us in the room want to be waiting until the 15th of March to make those decisions. I would encourage you to start doing that now. And then the 31st will be a huge report day when we get the planting intentions numbers from USDA. That'll be their first official set of numbers based on producer surveys that take place in the middle of March. So be very, very interested to see what those numbers are on that date. And by the way, I'll hand out some cards here in a minute, but that show some of our marketing services. We've got a lot of offerings that we offer through NAU Country. The opening bell phone call I put out every morning about 8:35 is when I record it. It's about 2 minutes long. You get it 2 minutes later. Just gives you an update on how the market's opened in the morning and why. The market report email comes out in the afternoon or evening with an update on the markets that day. We'll update charts, crop insurance prices, you name it. If you're interested in either of those and not getting them, let us know. We can get you hooked up, put your name, email, phone number on a piece of paper, give it to one of the agents, we'll get you set up. I mentioned the aftermath webinar that we do each month, the day after the crop report. I have a podcast called Kicking Up Dust. It's on Podbean. You can subscribe to that if you want. Get notifications when one of those gets posted. And I usually tweet out about the markets every morning around 7:30, 8 o'clock, how the overnight trade did. Haven't been kicked off Twitter yet, so apparently I haven't said the wrong stuff to the wrong people. But the point is that we do a lot of things to get information out to you on markets. We definitely are in the insurance business, but we want to see you be successful. Use your policy to market when the market gives you good opportunities, and want to try to help you with that. So one last thing I do want to mention before I hand it off. Remember your responsibilities with your federal crop insurance policy, that you cannot receive an incentive to write your crop insurance policy with a particular agent. Doing so could cause you to forfeit your coverage. We were at a meeting the other night and they were joking about another agent somewhere that was trying to give trips to Vegas in return to write your policy. Can't do that. If it gets found out, and I don't think anybody in the room would turn you in, but if it gets found out, you could lose your coverage. You'd have to pay the premium, lose your coverage, and be kicked out of the program. So we don't want that to happen. We just wanted to remind everybody of the rules. So with that, I appreciate your time. Any questions, comments? Thoughts on 22? Believe me, it's a lot more fun giving this talk this year than it was with $3.95 corn. Trying to figure out how we're going to make it work at $3.95 and how we're going to create that into profitability and all that good stuff. This is a lot more fun. So take advantage of it, because history tells us it doesn't last forever. So thank you.
Thanks, Rich.
My name is Courtney Apperson. I'm the Cass County Executive Director, and I'm also the acting CED for Trail County since Ray has retired. We're going to go over the 2022 ARC Plc Election Enrollment, the CRP program, marketing assistant loans, reminders, deadlines, and a few job opportunities with the USDA. So the agricultural risk coverage and price loss coverage programs, the deadline is March 15th, as stated earlier. We want to make sure that you guys get in and signed up by that deadline. If you don't make it in by the deadline of March 15th to make your election and your enrollment, it defaults to your last year's elections on there, which could possibly affect your crop insurance if you chose supplemental coverage and you had Ark County on your elections last year. So the Ark Plc election period for 2022, it opened up in October of 2021. I think it was like the third week in, and it will go through March 15th of 2022. And you will have the option again in 2023 to make your election enrollment as well by the March 15th deadline. Just a few reminders on the price loss coverage program. It provides a price loss coverage for selected covered commodities on the farm. Payments are triggered when the price of a commodity falls below the reference price. It's not dependent upon the planting of a covered commodity on your farm. Again, those were prices on the previous PowerPoint. Corn's $3.70. Soybeans is $8.40 per bushel. So if the marketing year average drops below that price, that is when a payment will trigger on there. This is just a little snapshot of the projected 2021 price loss coverage payment rates. Those will come out this October. Again, we pay a year behind because the marketing year goes until September 30th, which is why your payments come out in October. And right now, the only payments that are going to be generated, it looks like, are peanuts and rice. And there's another shot of that. Agricultural risk coverage, as we talked, is an income support based program. Covers a portion of the farmer's out-of-pocket loss. It's a shallow loss. It's when the actual revenue falls below the guarantee, 86% of the benchmark revenue. There's two options with the agricultural risk coverage option. You have your county option, which is based off your county yields and your marketing year average prices. And then you have your individual, which is based on your own individual yields and the marketing year prices on there. Now with the individual, Ark County and PLC, you can make it on a covered commodity by covered commodity basis. So if you have corn, soybeans, and wheat, you can select PLC for wheat, Ark County for corn and soybeans on the farm. Ark individual, the entire farm and all the base acres have to go into Ark individual, and there needs to be a planted covered commodity on that farm. 100% prevent plant is an exception. If there's ever a situation where you can't get anything planted, that is an eligible covered commodity. Again, it can be on a crop by crop basis. It's for all the covered commodities on the farm. Here are the covered commodities. Depends on what's on your farm, what you have for planting history. Base acres have been set up many, many years ago. We haven't had any new farm bills to increase, change, or add any base acres on there. And for more information about the Farm Bill and FSA and some different options on here, where you're encouraged to go to the NDSU Extension site. They have good information on there and good tools for you to utilize for your farms. The next program we're going to talk about is the Conservation Reserve Program. The Conservation Reserve Program is a voluntary program. The 2018 Farm Bill increased the acres that we have from 24 million to 27 million acres by 2023. Contract terms are 10 to 15 years, depending on what practices you put in and what sign-up you go into. Most practices have a general cropping history requirement. They have to be planted 4 of the 6 years between 2012 and 2017. Participants must have owned or operated the land for 12 months prior to the end of the sign-up, unless needing an exception on there. And producers are required to annually sign the 578 to certify their CRP every year. So the new sign-up that we're going to have start on January 31st and run through March 11th is the General CRP Sign Up. The General CRP Sign Up is kind of a nationwide competition because you're competing with everybody across the nation on getting in. It's kind of a point system based, depending upon what practice you put in, depending upon what rental rate you use on there. It looks also at water quality, erosion. Basically, it comes up to the total of the Environmental Benefit Index score on the CRP offer. So if you get 150 on your general offer, and the national office reviews all the offers that are submitted in and decide 175 is the cutoff, you have to have 175 or above to be accepted, then unfortunately you don't get in. We never know what the national office is going to pick for a number on there. It is a gamble. So there are things you can do to increase your points. Like I said, reducing your rental rate gets you extra points on there. Agreeing to establish a more desirable grass mixture practice can also get you additional points on there. But I would caution, just make sure when you are signing up for the CRP program that you are putting in a practice that's good for your farming operation. I mean, there's no sense of you putting a pollinator habitat in if you're thinking about potentially haying your CRP at some point in time. I mean, you want to do what's best for your farming operation, not just to get the points in, not just to get in. The continuous CRP sign-up, there is no sign-up deadline on that. It can go in all year round. It targets more environmentally sensitive areas, so high salinity soils on there. If you're wanting to put shelter belts in, riparian buffers, filter strips, things like that. That is 90% of the county average rental rate. I should note the general sign-up is going to be 85% of the average cash rental rate for the 3 predominant soil types. So there is a little bit of difference from the general CRP sign-up to the continuous CRP sign-up on there. And the contract can start on the 1st of the month after approval and be delayed up to 6 months from approval. So you guys could come in, say in May, and you know when you went out and you were planting and just thought, now there's an area I want to put in. It's kind of really high salinity soils. I want to take it out. You can come in, mark the area on a map, and then you can delay it up until November to start. When you want to sign up for CRP, make sure you visit the office and mark on a map the land that you're wanting to put in. What we'll then do there is determine if that's going to be a continuous CRP practice or if that's going to be a general CRP practice that you'll want to sign up for. And then we'll initiate the offer, go into the system and get it loaded. We can let you know what your rental rate is going to be on there. If you're going for the general CRP program, we'll discuss points with you, things that you can change to maybe get your offer accepted in. And then once you make a decision on if you want to go forward with it, we can process the paperwork and get you signed up. Marketing assistant loans, another program that we have going on right now. The marketing assistant loans are tools available during harvest and shearing. They provide interim financing at harvest to help ag producers when the markets are at a particularly low time during harvest. So you can seal a grain bin with us, and then when prices are better and you want to go market your grain, just pay off your loan. March 31st is the deadline to apply for barley, canola, cranberry, flaxseed, honey, oats, and wheat. May 31st is the deadline for corn, dry beans, soybeans, and sunflowers. Here are the Trail County loan rates for 2021. A couple big reminders too, as you guys are starting to come in and do your ARC PLC sign up, please be sure to bring in copies of recorded deeds if you've purchased any land this past year and maybe we aren't notified of it, or if you're changing farms, if you're no longer going to be on a farm, or if you added a new farm in, we'll need a copy of that lease to put you on the farm so that we can release the maps and the information to you on there. So make sure that you bring those in, as well if you have a change in your farming operation too. We'll update your eligibility paperwork on the CCC 902. We can do recons if we need to for owner-operator changes. And also notify us if you have any changes with your banking information as well. Don't want to run into, well, where's my payment? Oh, did you tell us that you changed your bank or not? So let us know on that. And then, of course, sign up for the ARC PLC program. One of the good things with COVID is we did start using the one box application. And what it is you can call the office and tell us, you can be sitting with your crop insurance agent and decide you want to do supplemental coverage and sign everything up for PLC. If you call the office and say, I want to enroll my farms in PLC, we can send you an email that you basically have to click a couple buttons. You electronically sign your contracts and it sends it back to us, and you don't have to come in the office. You don't have to print off the application, try to sign it and scan it back. It can all be electronically, which is a really nice feature. Makes it convenient for you guys too. We do ask, please call ahead to set up appointments before coming in the office. Again, we can maybe utilize one span to get signatures from you guys to save a trip in. But if you want to come in and see us, by all means, of course, come in and see us. We're happy to see you guys too. A couple important deadlines. We've got the March 15th deadline for the ARC PLC election enrollment. Again, if you don't get your election enrollment done by the March 15 deadline, it'll default to the previous elections. You can still late file enroll it, but like I said, you can't change your elections on there. March 31st is the deadline for marketing assistant loans for barley, canola, cranberry, flaxseed, honey, oats, and wheat. And May 31st is the deadline for corn, dry peas, soybeans, sunflowers. July 15th is the the acreage reporting deadline, and it's also the 2021 ARC individual production reporting deadline. So if you signed up for ARC individual last year, you do need to turn in your 2021 yields to us so that we can calculate your payment out for you. Again, ARC individual is based on your individual production. ARC CO, ARC county, is based off the county production. And some job opportunities with the Farm Service Agency. The Cass County FSA office is looking for a county program technician. If you know of anybody who would be interested in applying for the job, we carry out the office duties, help producers sign up for farm programs. You might be in charge of administering one or more of the program areas. It's full-time, permanent. The job is located at the Cass County FSA office in Fargo. It opens today and will close on February 10th. To apply for any Farm Service Agency or just USDA jobs in general, all applications are posted to usajobs.gov. And then I also want to mention the County Operations Trainee Program. With Ray retiring, we do need somebody to be a CED. I'm the acting one right now, so you guys are going to have to put up with me for a little while until they get someone full-time in there. But you have to go through a trainee program to become the CED at the office. It's a one-year management and management program, and you go over the FSA policies, and again, you must complete it to become a CED. So if you have questions or if you know of anybody who's interested in working for the Farm Service Agency, it's a great way to get your foot in the door. Just have them reach out to me. And then last but not least, Gov Delivery emails and text messages. The USDA, we utilize Gov Delivery to send out emails to producers once a month about important deadlines and dates, just some articles on things that are programs that are coming down the line, things that might be important. So if you haven't already signed up for the Gov Delivery, I would definitely do so. That way you'll be the first to know about, the general CRP sign up going out. Not only do you receive emails from Trail County, but also North Dakota sends out emails as well to your email address too. And then we also have a text messaging service available as well. So we can send a quick little text message to you guys. Reminder, March 15th, need to sign up for ARC PLC program. To do that, you need to text 372-669, and then you put the state abbreviation and then the county name after that. So for Trail, it'd be ND Trail. And so we don't send more than 2 text messages out a month, just so you guys know, but it's a great way to know about programs and things going on in the office. That's all I got. So pretty short and sweet. Any questions for me? Good? All right. Thanks.
Thanks a lot for coming out today, everybody. It's nice to see you all here on a really nice day. I'm Mike Gower. I'm from Aberdeen, South Dakota. I'm a field rep for NAU. And I want to talk to you today. We're going to be going into this year with some of the highest guarantees that we've ever had. And I just want to talk to you how to maximize your coverage and get the most value you can out of your crop insurance policy. March 15th, the biggest day in crop insurance, sales close date. That's the date that we have to decide on our coverage level, any options we want to buy, any endorsements like SCO and ECO that Rich talked about. We have to decide all of that by March 15th, and that'll be here before we know it. Production reporting date is April 29th. You have to have your production report into us by then and signed, but please don't wait. The sooner you get the production in to your agent, he can get that into our system, and we can give you the most accurate quote possible that way. And with these higher projected prices, premium's going to be higher than it was last year. I think all of you already know that. And we want to make sure that we can get, like I said earlier, the most value we can out of your policy for you. Acreage reporting date is July 15th. Premium due date is August 15th. Our bills go out directly after that. Interest starts on October 1st. And having said that, please remember that a pending loss doesn't extend that interest date or anything like that. Interest still attaches October 1st. And having said that, please know that companies have to determine a timely payment by the postmark that comes into us. And please know that small town post offices do not postmark mail unless you ask them to. So, you know, if you're bumping up pretty close to that deadline, please make sure you go in and get it postmarked. You can take your check to your agent. He can take a picture of the check. If it doesn't get there on time, we can maybe back that up like that. But, you know, we had our fall billing September 30th. It was taking almost 30 days for some of those checks to get to our lockbox. So everybody knows the mail is slow. So, you know, please make sure that we get everything timely. We don't want to charge you interest. Also, that March 15th, if you still owe on your crop and multi-peril policy, it has to be paid by March 15th. If it's not, you go on what we call the ITS list and we have to cancel your policy. You can't have a policy for that next year. But the slow mail and everything, I had 2 policies on that fall sales close date that we had to work with RMA to get them reinstated, and it's a cumbersome process. Please don't put yourself or me through that. It's not a lot of fun. So, if you would have your policy with NAU, you can go on to the farmer portal, register for an account. You can pay your bill online right in the farmer portal. We also have a number you can call. You can call our accounting department, give them your account number, your routing number, and you can pay right over the phone. So we do have a couple of options, but please help us out. Net farm income, you can see to the far right, that's 2020. It's a pretty good year for farm income, wasn't it? 2021 is looking also really good. You know, high commodity prices, areas that Rich showed you on his map that had a good crop. It was a really good year. You know, in the Dakotas, we had crop insurance is a big part of that farm income in 2021. My home county, the county yield this year is probably going to be 45 bushels with a 150 corn APH. So there's a big area, the central Dakotas, where the crop insurance check is the main source of income this year. So like I said earlier, we want to help you out with that, and we want to get you the most value out of your policy that we can. I know Rich really pounded on SCO. I'm going to do it again because I think it's something that can really work to your advantage this year. The first thing about SCO is please remember you cannot have ARC. If you would buy the endorsement on a farm number or a crop that has SCO attached to it at the FSA office, you have to pay 20% of the premium, and you do not qualify for an indemnity if there would be one. So you do get penalized, so please be careful about that. One thing I really do like about ARC is the liability is determined by your APH. So that's how we determine the liability. Typically, SCO and ECO is going to work better for growers that have a higher APH than what the county yield is, because you're getting the benefit of a higher APH when we do the calculation for liability. But the amount paid out is based upon how well the county does. So that's based upon the county yield and the harvest price then. That payment will happen the year after. It takes, those final county yields are based upon RMA data now. That April 29th production reporting date I talked about, that's when we get everything in and then we have to send it off to RMA, and those county yields typically come out the end of May, the first part of June. So if you do buy SCO or ECO for the 2022 crop year, and you do qualify for an indemnity, it won't be paid until June of 2023. Just something to keep in mind. But I do think it is really important that they're now using the RMA data instead of the NAS data. You can see, I think they started 3 or 4 years ago, and those county yields have climbed quite a bit within those last years because that RMA data is so much better. Also with SCO, the government pays a 65% subsidy on it. So, you know, NAU, every other AIP out there has add-on products where you can buy a higher price. It's a private product, there's no subsidy, so they typically cost quite a bit more than what SCO is. ECO, if I'm not mistaken, the subsidy is 40%, so that ECO is going to cost you more. On this slide, the last thing, I just want to talk about the final bullet point there. Indemnity payments for SCO based on whether the yield or the revenue. The revenue is the key thing we need to look at this year, falls below that county expected level. So I think with the higher projected prices, we really need to look at ECO and SCO to add a layer of a layer of revenue protection on top of your multi-peril policy. You know, please take a look, first of all, at raising your coverage level. In South Dakota, that works where premium isn't quite so high. Maybe doesn't work quite as well up here in North Dakota, but that is the first thing. Please take a look at raising your coverage level on your multi-peril. And then after that, please do take a look at SCO. You know, when a couple days ago, it looked like we were going to go into February 1st when we tracked the projected prices about $9.16 on wheat, and look at years past. You'll see the high price, and on wheat it typically goes down quite a bit the following year. You know, will it do the same thing this year? We don't really know that, but if you add that layer of revenue on top of your multi-peril, you're going to have a pretty good chance of collecting something if that price goes down. Corn, you know, Rich talked about these, and you know, right now SCO, ECO look like a good thing, but if you go back when these prices were lower, that's probably when we're going to be talking more about ARC than we are about SCO or ECO. Soybeans the same way, but this is what I really want to show you guys, is how we really do calculate that liability and how SCO pays. I know these numbers are pretty small and they're hard to see, but if you would like this presentation, Kurt can email it to you. So it's so fantastic, I know everyone's going to want it, but let's just say that your APH is 72, okay? Remember, 75% RP policy, you can buy that 11% band up to 86%. So we take that 72 APH times that 11% coverage. Friday, when I put this together, the projected price was $903. Take that times $903, and you were going to get coverage of about $71.50 an acre. Premium on that is right around $10 in Trail County. So for $10, you're buying $70 worth of coverage. That's 7 to 1. That's pretty good bang for your buck, isn't it? And in this scenario, we're just going to say you raise an average crop, an average county crop as well. So the county yield for wheat in Trail County is 70.9. So, you know, your APH was better, so you're getting 2 bushels more than that county yield. So we take the 70.9, the harvest price, I'm going to say, came in at $7.25, so that's your 20% price drop. So basically what we do then is we take we figure out the expected county revenue. First of all, was $640 with that price of $903. The final county revenue, we take that 70 bushels times that $725, and it was $514. We divide the two together, it's a 6% net loss. We divide that 6 by the 11% of coverage, and it's a 52% payment factor. So in this scenario, you'd be getting 52% of that 71.52, and we'd be sending you a check $37 an acre. So, you know, that's pretty good price protection on that additional band of coverage. I took a look at corn as well. The county yield for Trail County is 161.30 with a 165 APH. You were getting right at $100 of coverage for not quite $13, just roughly. So, you know, that's still a pretty good ratio. $100 of coverage for $13, 20% price drop. It would work out where we will be sending you a check for $86. So, once again, pretty good revenue protection. Soybeans with a 44 APH, you're getting $62 for not quite $6 a premium. So, you know, you're probably getting more bang for your buck on wheat and soybeans than you are with corn. And a 20% price drop with the soybeans with an average crop, we'd be sending you a check for not quite $50. So, you know, we really do need to take advantage of these higher projected prices that we're likely going to be looking at. ECO, that can be a pretty good option too. There was a fair amount of this sold last year. Remember, with ECO, you can have either PLC or ARC. There's no penalty if you do have ARC on acres that you do buy the ECO endorsement for. Remember, you can go all the way up to 95% with ECO. That's only leaving 5% of your revenue exposed to any kind of a loss where it wouldn't be covered. You can buy your 75% RP, buy SCO to get you to that 86, and then add ECO onto that. And we did see some people do that last year. These are all the crops that ECO is available on. About every crop grown in North Dakota. One crop to really take a look at with both SCO and ECO is dry beans. You know, there is no PLC or ARC for dry beans, so you don't have to worry about, you know, anything with the Farm Bill. But I did run a couple of quotes in a couple of counties by request from agents, SCO for dry beans, and you know, that ratio of premium to liability dollars is really good on dry beans, and I think everybody in the room knows we're going to be looking at some pretty good dry bean prices this spring too. So if you do grow dry beans, please do take a look at it, and there's something else brand new for dry beans that we'll talk about here in a moment as well. PACE, I don't know. Well, I guess for one thing, we don't know a lot about it yet. RMA kind of unleashed this on us late in the season. They've promised us rates and training the end of January, and as far as I know, Crystal, there still isn't anything, is there? But what it is, I'm thinking by now everybody's heard about it in the ag media and everything. What it is an endorsement that you can buy that covers any inability to apply post-application nitrogen. You know, if you do that as a good farming practice, apply nitrogen after planting, there would be an insurable cause of loss where you couldn't get your nitrogen applied. This endorsement would help pay for part of that. It is available in a band of counties: Griggs Trail and Steele, Barnes and Cass, and I know it's 6 counties. I only have 5 on my map. I believe Barnes is the other one. That band of counties right there.
Mike, Josh has a question.
Is that going to include an additional premium, or is that?
Yeah, you do have. It is an endorsement, so you do buy. It does cost you additional premium. I've been told it's fairly cheap, but I can't say that for sure because we haven't gotten the rate download to put into our quota yet, as far as I know.
So if you buy that policy and let's say you weren't able to get your side dressing done essentially, and you had a yield loss, would you still maintain all your guarantees and everything, or?
As far as I know, I believe you would, yes. Yeah, And I apologize, we just don't have a lot of information, but.
If you meet your APH though, even though you maybe didn't get that applied, it wouldn't kick in.
Right, but my thinking is if you were to pay that premium and have that endorsement, and all of a sudden you ended up with a 50 bushel, under 50 bushels of your EPH, I'm using corn as an example, then would all your regular rules of multi-barrel kick in?
I believe so, yes. Yep. And we would have to ask for documentation. We would have to prove our cause of loss, which we could use weather data. And you would have to prove to us that you did have the fertilizer bought and you did have a means to applicate it. Is basically what we would need for the loss. But, you know, like I said, they promised us more information the end of January, and we just don't have it yet. And we don't have the rates that we were able to put into the quoter. So, but as soon as we do get that, we'll get more information out. Third-party damage, this was a really good thing that RMA came out with about 3 years ago. Basically what it is, if you have damage to a crop from the actions of a third party and it's outside of any of your control, you can turn in a notice of loss, file an inspection. Please document what happened and when, and we can take those damaged acres off of your acreage report, or off of your production report. You won't have to report the production off of those damaged acres. So if you have a 100-acre soybean field, spray drift from your neighbor kills 40 acres, you won't get those destroyed acres pulling down your APH on the 60 of the good crop. You would only have to report the production off of those 60 undamaged acres. You still have to pay premium, but you don't have to report that production off of those damaged acres. So, you know, without those damaged acres, the 60 bushels might make 40 bushels. So, you know, you're still going to have that 60 for your proven yield for the year, where those 40 damaged acres, if they made 2 bushels or nothing, would really pull that down, and you would be stuck with that yield in your database until it went off probably 20 years later. So, you know, you're in the past, you were stuck with that poor yield for basically probably the rest of your careers as a farmer, where now you only have to report the good portion of that field. This is brand new for 2022. For those 4 crops that you see on the screen, you can now have an enterprise by type. In South Dakota, it was a pretty big deal. I have a couple of really big agencies. They put all of their winter wheat in, you know, an enterprise by type with their winter wheat. Next spring, they'll put all their spring wheat into another enterprise unit. And we'll talk about wheat here in a moment. But with sunflowers, you can have all your oils in one enterprise unit, your confectionaries in another. But please know that each enterprise unit has to qualify for an enterprise unit. You have to plant in 2 sections. You have to have 20 acres in each section. But there's different options that you can do. You could have an enterprise unit for your confectionaries, put your oils into optional. You could put both types into one enterprise unit. So there's different options, and I do have some charts here to show you in a bit. But please know that if you select enterprise by type, you can't have a multi-county enterprise unit, nor can you have an irrigated and non-irrigated enterprise unit. If you insure this by type, you can only do it by type for the crop then. Also, if you do have enterprise by type and we have a wet spring, keep in close contact with your agent, because if one of those types wouldn't qualify for an enterprise unit and we find out about it before acreage reporting, you have better options, you have more choices how you do want your unit structure determined than if we find out about it after acreage reporting. So if you do choose this as an option, please do keep in close contact with your agent. If there's any questions, your agent will call our underwriters, and we'll try to get you the best deal we can. Dry beans, this will be the big one in North Dakota that we'll see this with. Also with wheat, you can have your spring wheat. in one enterprise unit, your durum in another. Also, chorus and wheat, if anybody grows any of that, you can now have optional units on chorus and wheat. Also with dry peas, you can have separate enterprise units by type. So anybody out west where they do grow dry peas, this is probably likely to be pretty big for them too. But this is the chart that maybe makes it more sense for you. You can see on the left side there, they have a separate enterprise unit for their pintos, their navies, and their blacks. On the right side, you can see where you can have an enterprise for one type, still have a basic or optional unit for another type. This slide, you can put all your types into one enterprise unit. We probably won't see very much of that. But on the right, you know, this was kind of how things have always been, separate optional or basic units for all your different types of beans. If you did plant any winter wheat, we have to know about it. Please let your agent know. They'll turn in an inspection, and it does have to meet a stand count appraisal before we can attach assurance to it. Native sod procedures, nothing's really changed. There's a premium subsidy reduction of 50 points. You don't get YA, and you only get 65% of the T yield for 4 years. These are some of the options that we need to think about before March 15th, and there's a few of those I want to talk about that can really help you get more value out of your policy as well. Yield exclusion is a big one. I get all kinds of questions. Are 21 yields in the drought areas going to qualify for yield exclusion? We really don't know yet because a county yield has to come in 50% under the 10-year county average. And remember, I told you we don't get that data until we get all our production reports in and turn it into the government. It'll come out the end of May. So we won't know if we can exclude 2021 until May, and of course that's too late for your policy for this year. So I know some of them will qualify, but you won't be able to get the benefit of that until 2023. But please do take a look at yield exclusion. If you select it, it will take off every yield that qualifies for your crop for that year. We have a really good tool in our system where you can go in and select the ones you want to get rid of, because you know everybody knows how spotty the rains were this year. You might be in the good part of the county and had a good yield that you don't want to get rid of. So you know your agent can run that report and we can mix and match and get you the best deal. And what yield exclusion does, you take out those bad yields, and then it will bring your APH up. And you might wonder what that might cost. It depends on how many bushels it adds to your APH. But right now, if you even add 2 bushels of wheat at $9, that's $18 that you're adding to your guarantee times whatever your coverage level is. So I keep going back to the fact we're trying to get the most value we can for you with your crop insurance policy. Personal T yield, that's a big thing here in North Dakota. We've beaten SCO and ECO to death, but please do take a look at them. Malt barley endorsement, if you plan on growing malt barley, we have to have it on your policy by March 15th. We also need a copy of your contract by acreage reporting date. The last thing I want to talk about here is quality loss option. This was brand new for 2 years ago, and what quality loss option is, if you filed a notice of loss for quality adjustment, wheat's been the big one in North Dakota 2 years ago with falling numbers, vomitoxin. If you filed for a loss for quality, you can put this onto your policy, and what that does is it brings the production to count. You can use the production to count before the quality adjustment for your APH for the year. So, anybody that grew wheat 2 years ago knows that quality probably took your production by half. Well, if you select this option, you can add that back on, and you can get the benefit of using that production to count as your APH for the year. And once again, the cost is however many bushels it adds, and with that higher projected price, it's going to be well worth your money to check this out. And it doesn't matter if you actually got paid for that loss or not. You can still qualify to get that pre-quality production to count. Prevent plant, there's a couple of new changes, and let's hope we don't see a scene like this for a long, long time. But the biggest change for prevent plant for 2022 is last summer, RMA sent out a memorandum that they rescinded that November 1st date for haying, baling, grazing, silage, baleage, a cover crop. That November 1st date is gone. So if you plant a cover crop, you can hay it, graze it, basically do anything you want with it anytime you want. The one thing you can't do is you cannot harvest it for grain or seed. If you would do that, then you are subject to a reduction in your prevent plant payment. And RMA thinks that since livestock growers are getting a benefit for cover crops, they took out the language where you can't cash rent prevent plant. So now you can cash rent prevent plant to a livestock grower to plant a cover crop for feed. The other thing that they did is you can no longer consider corn a cover crop. If you plant corn on any of those acres, it will be deemed that that is a crop planted to harvest. So no corn. Also, if you would cash rent your prevent plant ground, please make sure that whoever would do that knows the rules about what you can and can't do. Because if they would plant a cover crop, let's just say they plant hay for oats, end of August, it looks really good, they harvest that oats for seed or grain, then you as the landowner and the policyholder would be subject to a prevent plant reduction in your payment. So I don't know if we like those rules or not, but that's what the rules are, okay? Some agents didn't even want me to tell anybody about the cash rent thing, but I talked with Kurt and a few other guys here, and we decided they wanted it to come from us instead of a rumor someplace. So that's where we're at with it. A couple of changes that they made in 2021, and since there wasn't a lot of prevent plant, we didn't really feel them or notice them. But now we will allow a producer to be paid a PP payment based on a crop rather than the crop that's planted in the field. Remember before you could do that, but you had to have a map to give to us showing that you planted both crops in that field one of the last 4 years. You don't have to do that anymore. Remember, you can claim a crop that isn't planted in the field. It has to meet the 2020 rule, and you have to prove to us that you did have the inputs to plant the crop that you're claiming. So when we have PP again, we'll see how that works. I expect a few problems. Another change for 2021 as well that, like I said, with a little bit of prevent plant that we had, it wasn't a big thing. But if you're a new producer of a crop in a county, you can now use your intended acreage report for 2 years. So, we always had to have that before. That's how we based your eligibility for prevent plant. But now you can use that for 2 years. RMA feels that it better reflects the crop rotation, the normal crop rotation, and it will make for a more fair payment. The 1 in 4 rule, I think we all know what it is. It has to be planted, insured, and harvested one of the last 4 years. That used to be just up here in the prairie pothole region, but now it is nationwide. And if any acres fall out of that criteria, it has to be planted, insured, and harvested 2 consecutive years. And what they changed here is before, in one of those 2 years, if you're trying to get eligibility established again, there couldn't be a loss due to flood or excess moisture. They've added the word drought to that. So in this past year, I know there had to be a couple of cases where some of this ground that hadn't been farmed in a while got planted, insured, and with the drought, it might have gone to an appraisal. It has to be harvested. So if you ever run into that situation, you're trying to get eligibility established in those 2 years, please do keep that in mind. If it would be really dry, you have to harvest it in order to get that linkage put back in. The other thing on this slide I'll talk about briefly, and I get calls about it every year, land coming out of CRP is not eligible for prevent plant the first year. RMA is making a big thing out of signatures like Kurt talked about earlier. You know, we have had a lot of high dollar claims this year. Every other AIP has too. And our RMA has let every AIP know they found a lot of errors in signatures. You know, and there's people signing documents that really don't have the authority to do that. So please know the authorized rep or a POA can sign do any amount of crop insurance business. You can also give someone the authority to sign. And you know, we had a case in Minnesota. There was a young farmer, didn't have any family. He didn't have anyone authorized to sign. He unfortunately passed away this summer, and it took forever for us to be able to settle his claim. So anybody can have the authority to sign. It doesn't have to be a relative. It doesn't have to be a shareholder in the policy. You can authorize someone to sign right on your application. So, you know, please do think about that, and you can do it with your agent when you go over, you know, your application for next year. And what someone that has the authority to sign can do, and the biggest thing that we see that they do is sign claim documents. That's the biggest thing. You know, if someone's busy harvesting, the adjuster is there, calls the guy out in his combine, you know, tells him what he found. I got the paperwork ready to sign. He said, well, I'm not going to stop harvesting, but so-and-so has the authority to sign. They're in the shop, they can sign it. You know, that's what they can do with claim documents. They can also sign acreage reports and production reports, and they can change levels of coverage too. So if you're at a 75% level on your soybeans, you want to go up to 80, someone that just has the authority to sign can do that as well. What they can't do is add anything to the policy. They can't add a crop, cancel coverage, transfer coverage, or start a new application. That has to be the authorized rep or a POA. I know if a POA, POAs at FSA are fine, but they do have to have the language in there that specifies that there's language in there to specify that it is applicable to crop insurance as well. And I know there's some older ones that don't have that language, and apparently some of those showed up and RMA did not like it. We actually got a phone call that everybody that works with the company had to be on a webinar about signatures. And I know talking to some people with some other AIPs, they did too. So RMA didn't like what they found. Yeah, Mike?
They also provided some direction on how they wanted the signature, right? So if you're signing.
Yep, we'll talk about that here in just a moment. Yep. But please know, you know, that any POA, even if you have one done up, it has to have language in it that it is applicable to crop insurance. So that'll help us out a lot. This is what Mike was talking about as far as an acceptable signature. The policy reads ABC Farms Incorporated. We need the printed name and the signature area on the application reads ABC Farms Incorporated by Joe Farmer, President. So that's what we need as a correct signature. That would be the correct way to sign a document like that. Just Joe Farmer, President would be acceptable, but if just Joe Farmer alone without the title would not be acceptable. And that is exactly the sort of thing, Mike, that they've seen before. So please make sure that whoever is signing your policy documents has the authority to sign, and also please make sure that they get signed timely too. That's the timeliness in all of this is very important too. Just a quick review on how your policy works. With a YP or yield protection policy, it protects only a production loss. There's no price movement involved at all. The projected price is used to establish the guarantee, and the production to count will always be taken times the projected price. And this is how that works. If you have soybeans with a YP policy, 36 APH, that price comes in at 13 bucks, 75% level of coverage. At harvest time, our bushel guarantee is 27. We only harvest 20 bushels. So basically, we take the 27 guarantee, take off the production to count. We're missing 7 bushels. You get paid that $13. Please do keep in mind, there is no harvest price option on a YP. If that harvest price came out at $14, you're still only going to get paid the $13. We all know a revenue policy works different than that, don't we? And we'll talk about that next. That guarantee is based upon the higher of the projected price or the harvest price. 2021, we had a higher harvest price, didn't we? So, which leads me to tell you, I got a lot of calls last summer about what the upward limit is on your RP policy. You know, we're looking at $9 right now on wheat. The upward limit is 2 times the projected price. So we would go up to $18. If wheat would go up to $19, we're not going to give you the $19. You're going to be stuck with the $18. However, there is no downward limit. So, like Rich said earlier, if our president would say something really stupid and create a meltdown and that price would go down to 0, we would be liable to pay you for that. But this is how it works with an increase. Remember, you always get the higher of the projected price or the harvest price. So we're looking at a projected price of $5.50 with a 120 corn APH and 75% coverage level. That gives us 90 bushels of guaranteed bushels times the $5.50. You have a $495 guarantee. We raise 80 bushels. The harvest price goes to $6. We recalculate that initial guarantee because the price went up. So we do the same calculation on those 90 bushels, only we take that by the higher price of $6 compared to $5.50. That bumps up our guarantee to $540. Then we take the production to count times the higher price is $480, and we would pay you that difference of $60. So, you know, basically we're missing 10 bushels. We paid you that higher price of $6 for that. That's how it works when the price goes up. The price decrease, which possibly we could be looking at this year, we'll look at wheat, $9, 75% coverage, 55 times 75, that gives us a guarantee of 41 bushels. Times $9 is $369. We harvest right at our guarantee. The price goes down to 70. We redo the calculation, take that 40 times the 7, that's $280 of production to count. Subtract that from the initial guarantee, because remember, the projected price was higher, so that's what we use. And we will basically pay you $89 on a revenue loss. So that's something to keep in mind as we go through the growing season this year, if we're lucky enough to have a good crop, because we could well be looking at a lower harvest price. So if those two scenarios happen, the first thing you need to do is turn in a notice of loss. This is another thing that RMA is making a really big issue out of. You have 72 hours after you discover you're going to have a loss to turn a claim in. So please do it sooner rather than later. You know, RMA looks at the end of the insurance period. There are dates for crops, but by the end of the insurance period also means harvest too. And they take a look at tickets that come in, load logs, that sort of thing. If you got done harvesting in August on wheat, you didn't turn a loss in until November, they see that and they start to ask a lot of questions. So please just help us out. If you even think you have a loss, turn one in, and the adjuster comes out, you're over your production, all you have to do is sign a withdrawal of claim. That's never used against you in any way, and RMA is making it really hard for us to pay any claims that come in after these dates that I'm talking about. So please do keep that in mind. Prevent plant at 72 hours after the final plant date. If you can't plant in the late plant period, or 72 hours after the late plant period ends. On revenue losses, that last example I showed, you have 45 days after the prices come out to turn a loss in. And these are the ones that we see a lot of losses coming in late. You know, those prices come out. We track the harvest price in October for the row crops. They come out that first week in November. You basically have until the middle of December to know what your production is, then turn a claim in for a revenue loss. And it seems like every year we get people haul grain in January and the bushels weren't there that they thought, and people want to turn a loss in, and it's really hard for us to do anything about those anymore. A few claim reminders as far as keeping track of your production. Please keep track of your optional units, you know, a section. Please keep your records by a section. That helps us out a lot on claims and also in your production reporting that I'll talk about here in a minute. If you have any old crop in the bin, please let us know. We'll come out and mark that bin. If we don't do that and you have a claim, we have to count everything that's in that bin, and that's going to take money away from you, and we never want to do that, believe me. If you change the use of a crop during the year, we need an appraisal on it. That is your production for the year for anything we do an appraisal on. If you're going to feed anything, please let us know. We'll come out and measure the bins. We can use that not only in a loss situation, but also for your production reporting. And please make sure that somewhere when you turn a claim in, we have your cell number. That speeds things up a lot. But these are the records you need not only for a loss, but also for production reporting. Hard records are assembling sheets, anything you get back from an elevator where that final disposition of the crop went. You know, you can write what section it came from right on your assembling sheets for both claims and for production reporting. The soft records are your load logs. If you have a printable ticket from your grain cart, you weigh every load you take home, anything that you use that's coming out of the field. It could be simple as 6 red trucks and 6 blue trucks came off of section 25, and that's fine. We just need to know approximately how many bushels it holds, and we can do the math and prorate that production then. But you can mark your bins, we can measure those. Also, even if you're not having your combine calibrated for production, we can use any printable documents out of your monitors for your load logs as well. That works really good too, and it just helps make your claims get paid accurately, and the better records that you can give us, they'll get paid quicker as well. But production reporting too, RMA is getting tougher on this all the time, and when your policies get reviewed, if you're missing something, it can be very bad for you. And also, if you have enterprise units, but you are keeping your records on an optional unit basis, which is by section, please have those records, because otherwise we basically have to prorate all that production out through your policy, and claim-wise that could take some money away from you. Also, there's some ramifications. Production reporting too. If you don't have those records, basically we have to give you an assigned yield. If you don't have the records to support your production, an assigned yield is 75% of your APH for that crop year. So this is really important on good years. Let's say you have a 150 corn APH, you raise 180 bushel corn that year, but you don't have the records to support that. So we're going to give you 75% of that 150, which is 125 bushels. So that's what we're going to use for that year when we calculate your APH. And there's a big difference between that 125 and 180, isn't there? So, you know, the next time you have a claim on that unit, that's going to cost you some money. So please keep good records. Also, if you over-report by more than the 5% tolerance, we have to give you one of those assigned yields too. So it's really important to keep good records, not only on the claim years so we can get you the most money we can, but on the good years too so you can build that APH. Building that APH is pretty much the biggest thing in crop insurance. In this situation, the production was underreported. We don't assign a yield, but we do correct the database. This one, when I was in claims, used to do a lot of high dollar reviews. It's probably the most common. The production was overreported, but less than 5%. But we still make that correction, so you know it does bump up your APH a little bit, which is to your benefit. And this is the ugly one. You know, it was over-reported by more than 5%, so we have to give you that assigned yield for that year. So please just keep the best records you can. If we can help you out in that in any way, please let us know. Just a few things to wrap up here with. If you do have your policy with NAU, we can give you some really nice technology. You know, I already mentioned you can pay your bill online. If you register for an account and your policy is with us and your fields are mapped, we can give you what we call field insights. And this can give you weather data right down to your field. It can give you the current weather, a forecast, and also a historical weather. So, you know, if you, at the end of the season, you know, you get done, you're going through your production records, you wonder what the hell happened with this field that it was so bad. You can go back and bring up the historical weather data there and find out, you know, maybe that really hot week in July, that was the last field you planted, it wasn't mature, the heat was harder on that than the rest. That's the sort of thing you can research. It will also give you wind speeds and wind direction. So, you know, you get on your computer in the morning, you can decide which field you might want to start spraying that day. Also, there's a spray window advisor in there as well. If you have a field that's surrounded by the neighbors, you don't want spray drift to go on there, you can go into the spray window advisor, enter criteria, and it will give you a window in the next 5 days of when the wind speed and direction and humidity, inversion factor, all of that will meet the criteria when you can safely spray that field. It'll also give you a growth model. You can enter the plant date, the maturity of the crop. It'll keep track of the growing degree days during the growing season, and it will give you an estimated harvest date. I know policyholders that have this and they really use it. There's even some older guys that I was shocked that would do this, and they just love it. So I think it's really worthwhile, and it's free to you if you have your policy with us. You can also get Easy View weather. If it hails within a mile of any of your field shapes, you will get a hail notification. The agency can also sign up for that to get it too. That way, if you're away on vacation, anything like that, you'll get that notification on your phone. You can call your agent and have them turn in a hail loss. Like I said, you can get it on your phone. The first step is to register for an account in the farmer portal. After you get the account set up, you can go to the app store. You can download the app onto your phone. Not only can you get the Easy View weather and the field insights, all of your policy information is right on your phone as well. You can check the progress of a claim. The provisions are all on there. There's a lot of really good information right on your phone. You can take it with you wherever you go. If you notice that the claim is closed, it will give you the indemnity amount right there. The other thing we can do, we can also direct deposit claim checks if you would ever choose to do that with the permission of your agent too. But if you do have your policy with us, you know, please do take advantage of the technology that we can offer you. It's easy to get set up, and it's really easy to get in there and play around with it and learn how to use it too. If I can do it, anybody can, believe me. But Last winter, I got bored listening to Rich every day, and I learned how to use the app on my phone. So, but that's all I have for you. Does anybody have any questions? Okay, well, thanks a lot. It's been a great pleasure to be here with you today. Thank you very much.
Rich and Courtney for presenting.
Thank you for watching the Ihry Insurance 2022 Spring Update meeting on a recording date of January 28th, 2022. I want to thank Rich Morrison, Mike Gower, and Courtney Apperson for their contributions, and thank you for tuning in on behalf of Ihry Insurance.